Welcome to yet another episode of Expert Speaks. When the bull market is raging, the only asset class people remember is equity. No financial advisor dares talk to any of their customers other than the equity. Even if he dares to talk to them, he will be looked down and think that he doesn't know anything about the market and where the monies can be made. Every person there will become a fund manager on their own. But the reality of life is something different. There are various asset classes. Each asset class has its own behavior. Each asset class has its day. It's beautifully put by Mr. Saurabh Bhatia, who is going to be our guest speaker today, called The Romance of Asset Classes. If you do not understand this romantic story between the asset classes, probably you will not create an optimal portfolio or a strategy to build that wealth. Today's episode is all about understanding the interplay between the different asset classes, how, as an investor, you can create successful strategies by understanding the interrelations between these asset classes. Stay till the end of this video. It's a very, very interesting video. And if you are able to understand this and implement it, you have nothing to worry about. You will only create success in your investment activity. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, we have today to talk about this topic called the romance between the asset classes, a very eminent speaker, Mr. Saurabh Bhatia. Mr. Saurabh Bhatia, in every sense, is a towering personality. His knowledge about the subject, his grip on the fixed income, and the interplay between the different asset classes is a music for us to watch when he presents his case. To give you a brief background of Mr. Saurabh Bhatia, he comes with a diversified experience spanning across different profiles in fixed income markets, serving onshore and offshore investors across hierarchy. Over the last 2 decades, Saurabh has traversed through roles of managing as well as advising fixed income portfolios for corporate treasury, a retirement fund, foreign portfolio investors, life and non-life insurance, bank treasury, and lastly, heading the fixed income desk of a prominent fund house. He has served as fund manager at HSBC Asset Management, senior trader at ICICI Bank, and head fixed income at DSP BlackRock Mutual Fund. Saurabh started his entrepreneurial journey at Sapient FinServ in July 2021. At Sapient, Saurabh drives the strategies for rates, currency, commodities, which collectively matter the most for decisions on businesses, cash flows, and eventually investments. He brings in diversified experience, highlighting the prominence for macro strategies to identify turns in various asset classes. Welcome to you, Mr. Saurabh Bhatia. Look forward to a very simple understanding of these interplay between the asset classes. So let's make it as simple as possible so that everybody can understand this. And I know how effective and how useful your discussions on this, and I myself have followed it and implemented it quite efficiently in our day-to-day practice. My first question to you is, at the onset, please help to identify the purpose of the different asset classes.
Well, firstly, thank you, Mr. Bhatt, for inviting me onto your channel. As you mentioned, the romance between the asset classes, I think in a more technical words, parlance, it is we use it more as a multi-asset. But end of the day, what works when and what doesn't work when, that is what we need to make informed decision making. The purpose of multiple asset classes, I'll start with core two aspects, which is equity and fixed income. We relate equity with wealth creation. We relate fixed income with income generation. And that is a basic principle of these two critical asset classes, which are part of every discussion which goes into our investments in the portfolio creation. We've seen over the last 3 years how wealth creation has helped to generate returns. And as things evolve, we are seeing some headwinds coming into this entire process of wealth creation. And one of the aspects which is creating this challenge or the hurdle for wealth creation is elevated interest rates, which are gradually creeping up across the world. And this elevated interest rates is nothing but the other asset class, which is the fixed income. And as the rates go higher, or as the rates stay higher, wealth creation can take a little bit of a backseat. So, end of the day, the purpose here from a portfolio standpoint is to get the right balance between wealth creation and income generation. From a layman perspective, all we need to identify is just two components: cost of money and availability of money. Be it a promoter or an entrepreneur or a professional, these two aspects, the cost and availability of money, are very easy to identify, because as and when they start pinching us is when the cycles will move from wealth creation to income generation.
Mr. Saurabh, you mentioned about cost and availability of money. Can you elaborate a little bit on this? Does it affect only the fixed income, or does it have a bearing on other asset classes, how they behave?
Yes, this is the basis or the basic threshold for every asset class in itself, which is the cost and availability of money. And hence, from a layman perspective, I highlighted these two aspects. We often say we don't look at fixed income because our return profiles are less. But more importantly, we need to look at fixed income whenever the return profile is less, is when the equity will start doing well. Go back 3 years, your interest rates were almost zero in most developed economies, and hence it was very easy to create the wealth creation cycle. As months and years evolved, gradually the cost of money started to go up. The central banks started to raise money, and hence the interest rate started to get higher. As they reached at an elevated stage and stayed there for a prolonged period of time, the wealth creation exercise started to take a backseat. And hence, what has changed over the last 3 years is trends in cost and availability of money, which has moved from very low interest rates of almost 0% in most developed markets, now gradually increased to about 4 to 5% world over. And till the time they stay here for a prolonged phase, gradually we will see the interest rates as well as the cost and availability of money gradually pinching various aspects of economy, which includes our own consumption, which includes the eventual demand. And hence, as an investor, I will have to revisit the extent of money what I have kept for wealth creation and use it for a more easier, predictable asset class called fixed income.
Saurabh, you are a keen observer of all these trends. That's what you do every day. From your observations, can you pick up any trends at this point of time? Like, for example, money becoming easier, availability and the rates becoming easier from here onwards, or it is going to be tightening up. What do you see?
I'll give you a classic example what's happening in India. We just cut interest rates after a very long time, and the rate cut in itself hasn't had a significant impact on the yields in the market. Yields is the money at which the governments borrow, the money at which you and me borrow, or the corporates borrow. And the classic example of this cost and availability of money is addressed to what is happening in India. So what you have done, or what you have attempted as a central bank, is you have reduced the cost of money. But as the availability of money, which we call liquidity, is relatively tight, the impact of reduction in benchmark rates by the central bank is not showing up in overall rates coming down. In September of 2024, US cut rates by 50 basis points. But as we all know, since then, yields went up by almost 100 basis points because the availability of money in the system was relatively lesser. In other words, the liquidity was relatively getting lesser. So relate with these two terminologies. The cost of money is something what the central bank drives with its benchmark rates. Availability of money is something which is an additional component of liquidity in the system. And as we all know, this liquidity in the system is relatively tighter, especially in Indian context, which will need a lot of heavy lifting by the central bank to address the cost to bring the interest rates overall lower. Until the time this is not addressed, the wealth creating asset class, which is equity, may have to take a little bit more backseat. The risk reward may not remain as favorable.
What is your outlook on the rates going forward? What's the path which becomes visible to you as a professional now?
When we go into outlook of rates, just take 2 steps back and see what's happening world over. The governments across the world are saying we don't want to spend a lot more from here, which means they'll not borrow more a lot to spend more. US has this dodge exercise going on. India has said that we will be streamlining our fiscal deficit, which means the extent or the momentum of government spending is incrementally going to reduce. The government is the largest spender world over. Second largest spender is the corporate. Corporates have demonstrated that they don't want to spend considerably, except for the Max 7, the capital expenditure of all the corporates is relatively on a lighter side. And they have demonstrated that the private expenditure from corporates is relatively to remain benign. So government is not spending, corporates are not spending. Third, we go to the lenders. In Indian context, the banks are the largest lenders. The credit growth of banking system is just about 11-12%, which is at a very, very low level. And that means the bank's ability to push through lending is relatively on a lower side. And if the bank lending also remains at 11-12%, we have a weird scenario where government on its own, the largest spender is saying, I don't want to spend a lot more. Corporates have demonstrated we don't want to spend, and the largest lender is taking a backseat. So when the largest spender and the largest lender have taken a backseat, the consumer spending in itself cannot drive through the growth standpoint from an economy. So world over, we will get into a phase where the growth cycles will start tapering away. And as the growth cycle starts tapering away, central banks get a little bit more room to cut rates. And from a rates standpoint, hence, we have seen a fair bit of rate cuts in US. India has just started. So this will be a very small, shallow rate cycle. And hence, from a benchmark rate perspective, we may not see considerable change, 25 bips here and there. What matters us the most is how and when the yields will start coming down. Sadly, the scope for yields to come down, which is the government borrowing yields to come down, is relatively lower. So the cost of money for government is going to remain relatively elevated, which means the cost of money for you and me is unlikely to go down considerably. And hence, basis this to answer your question on outlook on rates will remain almost flat through most part of the year. The benchmark rates of respective central banks will reduce a little bit, but our borrowing rates will not significantly change to what we are seeing presently, maybe a 25 to 50 basis point impact, which may not move the needle enough for the growth to revive immediately for the economy.
That's because of the tighter money supply.
That is because the liquidity being relatively tighter. And the reason why liquidity is relatively tighter is over the last 4-5 months, a key aspect which has played out is the dollar has got very costly, or the dollars in itself has appreciated in itself, weakening a lot of other currencies. We can attribute various reasons for this. And as the dollar becomes a little bit more expensive and other currencies start weakening, the liquidity cannot come back into the system. And hence we will be in a phase of a relatively tighter liquidity, and central banks will be very wary of using their ammunition, which is the rate cuts. And hence, fewer rate cuts from central banks, and liquidity will be almost neutral to tight. And this phase of relatively tighter liquidity and fewer rate cuts doesn't bode well for growth to revive. And this is what is creating a little bit of challenge for equity markets, because if the demand doesn't come back, the consumption doesn't come back, then your top lines and input margins will not give you a favorable risk reward to the current valuations.
See, the discussion which happens around the marketplace is not what RBI is doing, but what Fed is doing. Everybody talks about the Fed rates. And we have got a lot of clients who send their remittances to India. They track their earnings, saving in multiple geographies. Please let me know what opportunities and challenges they have to face because of the current outlook on these rates by Fed as well as the Reserve Bank.
Yes, I mean, as I mentioned earlier in the earlier question, the dollar is more like the superpower from where all the outlook on markets are derived from. The Federal Reserve is a key central banker from where a lot of other central banks and other currencies take a cue from. As you're aware of what's happening these days, the outlook on any asset class, and particularly the dollar and the US Treasury, hinges on one last tweet from the US president. So the shelf life of our outlook is relatively smaller over the last 2-3 months. But to make it more tangible, what's happening right now, Federal Reserve has cut rates relatively more aggressively than what the economy and what the macro picture would have desired, because the government spending was at a rapid pace through most part of the last year. So from a Federal Reserve standpoint, their ability to cut rates will not be the same what it was in February of last year. So we will see the direction of rates going lower, but not to the extent what we got last year. And hence, if Federal Reserve is not going to cut rates aggressively, other central banks will not have scope to reduce it considerably, reduce their rates. And as the difference between Federal Reserve rates and the respective central bank rates, say in Indian context, RBI, as that differential narrows, the pressure on currency will start playing out. So if I'm earning abroad and if I'm sending the remittance into India, I have to keep a component of currency depreciation, which will automatically play out, not only in India, but any part of the world. And hence, from a dollar to a relative, any emerging market currency perspective, there will be an extra layer of currency depreciation which will come into play. And that can, to some extent, reduce the extent of returns what you can eventually earn, particularly on a fixed income perspective. So, merit to hold on to dollars a little bit more and use remittances on the basis of the requirements, because dollar is expected to remain relatively stronger. And second is EM currencies will have a tendency to weaken a little bit. And third, most important is there will be a fair amount of steepness in the yield curve. I'll just explain this point. The longer end of the yields will start giving marginally extra yields to the investor, be it on the corporate bond or on the sovereign side. So there is merit to hold on this money into the dollar assets or dollar as a currency before rushing away to put this money into an EM, no matter which part of the world we belong to. Because you expect EM currencies to have a weakening bias because of narrowing interest rate differentials. A lot of central banks like India, we've had superb macro picture. We have considerably increase the immunity of the economy to global price risk, to the global pressures. But narrowing interest rate differential is a little bit difficult to withstand, and this plays a larger part on the currency side as well.
See, when the rates change, it influences the currencies, or the currencies will have again effect on rates, a vice versa kind of an equation. In other words, does rates and currency outlook influence asset allocation and rebalancing requirement for individuals in their portfolios?
Of course, yes, currency is more like a medium. So if the value of the currency or the value of that medium is changing, then it will have an impact on the end result. For example, if I invested in a 1-year asset in India last year at around 8%, a 1-year CD, if my currency has depreciated by about 2%, that is the extent of dent what I would have on my overall returns. So as the rates change, it changes the extent of difference with US interest rates in itself. If India cuts more, the difference narrows to even a larger extent between India and US, and that can put some pressure on the currency. Important to note here, last 2 years, INR was a lot more stable, and what we are seeing is the realignment of this extreme stability what we had over the last 2.5 years, which has led to a little bit of fast-paced movements in INR over the last 3 to 4 months. So yes, rates have an impact on currency, and the movements in currency definitely has an impact on the overall returns on portfolio, especially when you are looking at cross-border investments.
Let's say there is an investor, he wants to identify the investment opportunities. From the points that you have told all these now, if he has to tick certain boxes, check this, check this, check this, how do you help an investor to identify what is that he should exactly tick to identify the opportunities?
There are 4 important boxes to be ticked when we look at any investment proposition. First one is liquidity. Second one is predictability. Third is obviously returns because it's investments. And fourth is lower volatility. I'll repeat, it's liquidity, predictability, returns, and lower volatility. Any investment avenue which we choose, it has to pass through these 4 musters. And if any of the boxes are not ticked, then it merits a revisit. Now, basis this, where we stand today, in the last 2 to 3 years, NRI Money Clinic would not have discussed ever on fixed income. Over the last 2 months, the extent of invitations what we get to talk on fixed income has certainly increased. And one reason why we are discussing this is because fixed income rates are elevated. And hence, if you're earning 8 to 9%, or if you can earn 8 to 9% dollar returns, then few things what we are ticking here is definitely predictability. 8 to 9% dollar returns is indeed attractive, which is a returns. The volatility is relatively lower on this segment of fixed income. So you are ticking 3 most important boxes. Now, to withstand the extent of changes in yields over the next 2 to 3 years, if we lock in into a product which we call as a fixed maturity plan or a close-ended scheme which can give us 8 to 9%, then this certainly merits a fair amount of allocation to safeguard the wealth what we have created over the last so many years in the equity markets or a wealth creation asset class. And if you look at from overall as a multi-asset perspective, till the time your dollar yields are around are yielding 8 to 9%, equity will the hurdle for earning in equity will have to go even much higher. And hence, what looks good today certainly is this 8 to 9% dollar assets or dollar returns, which can be earned through a close-ended fund with a maturity profile of about 3 to 4 years.
When you say 8 to 9% on dollar, it's a mouth-watering return. How do you create that kind of an opportunity? Or how do you design this strategy where people can get that kind of a return?
Well, there are funds available in the market, or there are strategies available in the market how you can derive these sort of returns. And when I say these are not high yielding credit strategies, first of all, so these are funds which have about 2/3 of exposure to investment grade assets. And hence, from a credit standpoint, they are not on the bottom of the layer by no sense. As these are close-ended products, the predictability factor of returns is relatively elevated. These are funds which are regulated from geographies like Singapore, where the regulatory framework is fairly stringent, and hence it ticks a lot of these boxes in terms of regulatory supervision, ring fencing of credit, as well as the entire credit universe which is made available before we step into these assets. So there are no downside surprises which come either through change in asset allocation, change in credit profile, and the duration profile is constant. And we don't look at this stage open-ended strategies because the corporate bond yields still are pretty tight world over, and they have scope to open up or there's scope to rise. So which is the difference between government securities and corporate bonds is very narrow today. This has scope to increase from here on. So if I were to look only at an open-ended fund, I could have a little bit more of volatility coming in. And that's the reason today when close-ended yields are giving around 8 to 9%, we look at these strategies for NRI investors as an easier, predictable return profile or return asset class.
When you speak about these opportunities, few things comes to my mind. One, they look to be very attractive. When did we hear about equity giving you 9-10% in dollar terms? So that itself is a rarity. But here you are talking about an yield from a dollar which is 8, 9 or whatever that is, which is available at that point of time, which takes me back to literally 2 odd decades before when you had this kind of a return. What comes to my mind is this requires a professional to identify these kind of an opportunities. And probably you need a financial planner or an advisor to figure out that amount of asset allocation to be done around these things. Is my understanding correct here, or is it something like a do-it-yourself investors go and pick up something and create like these kind of returns?
Yeah, I mean, you answered partly in your question. As you just mentioned, these are the phases what we had seen about 2 to 3 decades ago. And if you all remember the 90s, we had fair amount of currency depreciation coming through in many of the emerging market economies, especially the Asian financial crisis. India did well, exceptionally well, to remain immune or to stay away from that crisis. And I'm sure if something like that today happens, our macroeconomy and this currency will be able to withstand that. The role of an advisor, the role of a financial expert comes in here is he keeps a watch on what is happening on other asset classes, what they can potentially yield from here. And as these potential yields start varying, or as these potential returns start varying across asset classes, the person who is glued on to this particular purpose, which is the role of a financial advisor, he comes in not only to create this as an opportunity, and here it is very important to note this opportunity in an asset class or entry point in an asset class is most often also leads to exit of some other asset class. And we never say that A asset class is doing well, now B is also going to do well. When B is going to do well, it implies it's broadly a pause or an exit from, or exit at least the overweight positions in any other asset class in itself. So as you mentioned, the yields are mouthwatering. say around 8 to 9% levels on dollar rates. This certainly merits the extent of allocation which needs to go into these type of strategies, which can yield you a lot more higher predictable returns, and more importantly, safeguard a lot of returns what you've created by wealth creation, which is the equity side.
When we talk about fixed income, most people get an impression that it's a bank fixed deposit. However, there are bonds, there are currencies, intergeographical investments. This many a times gives rise to complex situations. Say, for example, somebody buys a bond and the bond prices, the face value may fall down. Likewise, the interest rates many a times creates opportunities. If somebody doesn't grab onto it, it can result in an opportunity loss. Sometimes people panic and sell looking at a notional loss. How people have to look at this equation of notional loss, actual loss, opportunity loss, how to optimize around it, and give me a simple formula for investors to follow in this.
The notional loss is basically if you invest in fixed income when yields are 1% and 2%, and eventually when the yields rise to 4%, your return profile is extremely low. And you have to wait till the time the yields fall back to 1 2%. So that is largely the notional loss, which if you don't sell that asset, it will just show up in your return profile as a negative return or as a lower return. Opportunity loss is when the yields are at 0, 1% or 2%, 1.5, 2%. If you are overweight on fixed income and underweight on equity, that's an opportunity loss. And on the same note, when the yields are at today, sovereign yields at almost 4.5%, or corporate bond yields at around 7% or 8% on dollar terms. When you ignore this and you stay over invested in equity, that's again an opportunity loss. Because it's simple, if the yields are so elevated, the input prices, the margins, everything are at risk from a manufacturer perspective, and hence from an equity standpoint, you will not get the desired momentum what you have seen over the last 2-3 years. So broad-based overweight on equity strategy may not work that time. Third is from an actual loss perspective. I invested at 1% yields when the yields were 1% into fixed income because the past returns were showing exceptionally well. They show well because yields would have come from 4% to almost 1%. Now, seeing that I invested at 1% in fixed income, I see over a period of 1 year, equity starts doing exceptionally well, but fixed income is not earning. So I sell that fixed income, get into equity again at a wrong time, because equities would have created a fair amount of momentum by then. So these things, or these switches from one asset class to another, if they happen at a wrong period of time, then that can lead to an actual loss. So very important to safeguard our portfolios from notional losses, opportunity losses, and actual losses. And that's where this romance between the asset class comes into play, because we should not get carried away, ideally. I mean, as much as in romance, love makes you blind. We should ensure that equity doesn't make us blind to what has happened in the last 3 years. We hated fixed income and the rates were 1, 2%, which is rightly so. But hatred should not make us blind over fixed income when the yields have come back to 7, 8% in close-ended products. And third is somewhere in between what we hear over the, especially last 2-3 months, somewhere in between, we all got colorblind because we forgot a very important yellow color metal, the way it has rallied over the last 1.5, 2 years, which is the gold. So we need to keep an eye on all the three asset class from a prospective return perspective. And a key driver for this, I go back to the first part, which is cost and availability of money. And to put this across, as an investor, he's doing the most difficult job, which is to earn his earnings. This is not returns, to earn his earnings. It can be a professional at his job or entrepreneur at his business. Now, these earnings eventually have to create its own returns in the form of investments. And as much as to create your own earnings, you have a broad-based framework to identify what works well and what doesn't work well. In 2021-22, I would have been, as a professional, I would have been fairly sure that my salaries can go up to this extent, my bonuses can come good. Today, I will not be as confident on my extent of same level of salary increase or my bonuses coming at the same base. And this turns the tide to an extent how I to choose the risk what I put onto my portfolio. because this is turned from an asset cycle also. And hence, it's very important at these times to ensure that the notional returns and my actual returns, they don't create a much bigger gap.
Saurabh, I have always admired musicians. There are countless musicians all over, but there are very few maestros. When we hear music, we feel, is it pleasing? Is it noisy? That's all we get. But we can't pick up ragas. You are one such maestro who can pick up ragas between the play of these asset classes. It again goes to say fixed income may look simple, but if you have to get most out of all these movements, that is where you need to be guided by proper experts, the maestros like Saurabh. And that is where probably you can make best out of the market movements. I have no hesitation to say this is what is required. Now that you are here, it's very difficult to get you. I know this. So I'll use this time also to understand a few terminologies which are very popular around fixed income. Say, for example, people talk about increase the duration, reduce the duration, increase the credit. Can you, for the benefit of my viewers, tell me what is this duration, what is this credit?
Well, these are the two strategies from where fixed income products make return. When you're longer in yields or longer in bonds, when the long end yields start coming down, you earn a lot more on fixed income because a fixed income product has two drivers of return. One is accrual, wherein it's more like a fixed deposit, and second is capital appreciation. So when yields are at elevated levels, typically we invest for longer tenors. And when yields are at very low returns, we invest in shorter tenors. So when yields are elevated, we tend to invest into duration assets because as the yields start coming down, I will get dual benefit of accrual plus capital gains. For credits, as a thumb rule, for credits to turn good, you need positive growth momentum and lower cost of money. I repeat, for credits to turn good, we need positive growth momentum and lower cost of money. If you look from here on, what we have is the growth momentum is not positive and the cost of money for credits is not going to remain low. 3 years back, credits did exceptionally well. 2 years back, credits did exceptionally well because from an economy standpoint, we had growth momentum which was positive and cost of money was relatively cheaper. And as both these boxes are unticked from a credit perspective, low rated credits is not a favored strategy how I would look at the current juncture. So identifying these phases, identifying these stages is something, again, it needs a little bit of a hand-holding. And that's what I'm sure you and your team at NRI Money Clinic are largely renowned for.
Dear viewers, as we get on with this discussion, needless to say, we as a team are trying to build an expert team to help people lock into the fixed income opportunities and help you out also. If you have an interest to look for good yields around fixed income, be it within India or in the dollar world, you can drop us a message. Our number is there in the description box below. There is a WhatsApp link which is provided. Click on the link, it takes you to the WhatsApp. Mention us what's your interest. Then we'll figure out whether we can be of any help to you to identify the exact opportunities you are looking for. Why delay? Send that message to us right now. Saurabh, by the way, if somebody wants to look at opportunities in fixed income, which one can they choose? Emerging market debt or a developed market debt? Are there any opportunities or do they have to be mindful of any of these things?
Very important part, and let me summarize this entire conversation on this basis to where you belong to. Largely what we mentioned from a dollar asset perspective was if there is an NRI who's looking for a predictable return and who can optimize his remittances, for him, the dollar returns are relatively elevated. But if you are an INR investor in India, the short end yields are very elevated because of tight liquidity. And hence, as an Indian investor, the domestic bond yields, especially at the shorter end of the yield curve, which is a shorter tenor, are fairly attractive to lock in these yields because even though we had a rate cut about a month back, the scope for rate cuts from here on is not so huge. So we are locking in at good levels because liquidity is considerably tight. And as this liquidity remains relatively tight, and there are a fair amount of unknowns to how the currency trajectory will evolve, not only from INR perspective, but from EM perspective, there is merit to lock in or earn this higher accruals with good quality assets in the shorter tenor. This is for an INR investor based out of India. From a global investor, cross-border investments do merit more granular revisits to the currency fluctuations because they can have a larger impact on the overall returns, and hence the dollar returns when they are relatively elevated, or the dollar yields when they are relatively elevated, certainly provide a more favorable risk reward in this particular phase when the dry powder to keep on cutting rates is relatively lower to what we had in February of 2024.
If someone has to choose between an open-ended debt fund versus a closed-ended debt fund, are these two same in today's circumstances, or is there have to be mindful of any of those points?
In a closed-ended debt fund, your return profile is a lot more predictable, and as all the maturities come closer to where your funds is, what is the target maturity of the particular fund. So we are looking at fixed income as an investor for predictability. And if my predictability box is getting ticked with returns as well as lower volatility, then I would more be keen for the close-ended products rather than an open-ended product at this stage. Open-ended product can get exposed to a lot more volatility as and when the yields start, the difference between the second corporate bonds start rising. And hence, I'll refrain from open-ended products now and confine to close-ended products in the fixed income space, which will be anywhere from 1 to 3 year perspective.
Saurabh, we discussed a lot of these points. I still feel that I need your expert opinions at frequent intervals of time. It's not easy for someone to understand the fixed income markets, its movement, and it's the dance it creates around that. From the observations that you have made from currency, Fed rate, RBI rate, growth prospects, equity, whatever the stage, what's your favorite trade if you were to be investing some money today?
Well, if I can potentially, as an NRI who's earning in dollars, who's not staying in India, who's staying abroad, if I'm able to earn close to 8% or marginally more in dollar returns, that is by de facto a very elevated level because that pushes the hurdle for all other asset class to earn much, much more higher. So in today's time, that becomes a favorite trade if I'm earning in dollars, staying in some other geography and not in India. And in India, my short-term yields are still earning me 8.5%. So I will be more looking at those yields to lock in good credits.
Thank you, Mr. Saurabh Bhatia. I have to keep calling you on my channel frequently to understand how things are changing. And when you explain from an expert view, probably we are able to make some kind of raga out of this. And over a period of time, we'll also try to understand how fixed income can also be a very, very attractive means of creating an yield. Most importantly, with that point you said, predictability. Predictability, who doesn't like? Everybody likes predictability. The real problem of equity is, yes, it gives returns in the long term, but how long, we do not know. And which year it will give, we do not know. The unpredictability is the thing which creates many times very bad experience for the investors there. Thank you very much for your time to come and explain all these interplay between the asset classes, currency, dollars, Fed rate, gold, fixed income, how they'll play around. Thank you very much, and we remain in gratitude to you for your kindness to come on our channel and explain all these points for the benefit of my audience. Thank you, sir.
Thank you, Mr. Bhatt, for inviting me, and look forward to a lot more conversations like these.
Dear viewers, we have made the first attempt in explaining to you the opportunities which come around fixed income. It's not as simple as it looks like. It creates a beautiful opportunities if you are prepared and if you are well advised by the proper experts on this. Over the next couple of months, we'll try and do more videos, try and bring to you the opportunities the fixed income creates from time to time. If you are not yet subscribed for this channel, please do hit the subscribe button and press the bell icon. Do like this video if it gave you the ideas around the fixed income. Please do share these videos with your friends and relatives, near and dear ones, and on all the social media on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Tuesday with yet another expert, with yet another topic. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.